Hello guys, welcome back to my YouTube channel. So in this video we are going to be introducing financial ratios. So in this video I'll be introducing financial ratios and the different types of financial ratios we have, and actually how you can use these ratios to actually analyze your bank statement. Welcome to the second part of the video on financial analysis. So in this part of the video we are going to be talking about financial ratios. All right, so one thing you need to understand about financial ratios is that financial ratios are actually a very important tool, all right, that is actually used by financial analysts, okay, stakeholders and investors, okay, to actually determine the financial performance and overall financial health of the business. All right, so one thing you need to understand about financial ratios is that it's actually derived from the bank statements of a company, okay. So we derive or calculate financial ratios from the bank statement of the company, okay, and it gives us an overall view, okay, of the company's financial health at any given point in time. All right, so I've actually created a sticky notes here. There will be jotting down important points. All right, so I said financial statements are derived from the bank statements of the company, okay. So we actually have different types of bank statements, okay. It could actually be the balance sheet, it could be the income statement, or it could actually be the cash flow statement, okay. So one thing you need to, let's talk about the balance sheet. All right, so one thing you need to understand is that another name for balance sheet is actually called the statement of financial position. All right, statement of financial position of a company, okay. And one thing you need to know is that balance sheet actually gives a snapshot, okay, of the assets of a company, the liabilities of a company, and the shareholders' equity of a company. All right, so when we talk about the liabilities, when we talk about the shareholder equity, okay, we talk about the shareholders' equity. All right, we actually mean the total asset of the company that is actually owned by each shareholders, okay. The total assets of a company owned by its shareholders. All right, and you can actually calculate the shareholders' equity using the formula total assets minus total liability. Minus total liability. Okay. Alright, so that's what balance sheet is actually all about. So let's just look for an example of a balance sheet here. Okay, let's look for an example of a balance sheet here and actually try to understand what balance sheets actually mean. Alright, so let's just choose this. Okay, so while that is opening up, let's go back to what we were saying. All right, so like I said, so balance sheet gives a snapshot, all right, of the assets, liabilities, and shareholders' equity of the company. All right, now when we are talking about the cash flow statement, all right, so the cash flow statement is actually another financial statement, okay, that can actually be used, okay, to derive or calculate financial ratios. All right, so when we are talking about the cash flow statement, okay, it actually shows the movement of cash. All right, it is a statement that shows the movement of cash in a company. All right, it shows the cash inflow and the cash outflow the company. All right. So this is actually what cash flow statement is all about. Okay. So it actually shows the money going in and the money coming in into into a company. Okay. So when we talk about cash inflow, all right, it simply means the money coming into the company. And when we talk about cash outflow, it simply means the money going out of the company. All right. Maybe expenses and all, and inflow maybe revenue and profits and the rest of them. So that is actually what cash flow statements, all right, is all about. All right. So another thing we are going to talk about is we are going to be looking at the income statement of a company. Okay, income. Let's read it. 18, 14, 15, whoops. So the income statements. Okay, so one thing, as the name implies, the income statement actually gives a summary, okay, of the company's financial performance over a period of time. All right. So the income statement shows the company's revenue, okay, expenses and net income, which is actually the profit, okay, of the business. Okay. So that is what the income statement is all about, all right? So the income statement shows the revenue, expenses. So, and some people refer to the income statement as the profit and loss account. All right. Gives a summary of a company's financial performance over an accounting period, usually a year. So the income statement actually shows if a company actually made a profit in a given accounting year or not. Okay. So that is where you see the total expenses of the company, all right? The total expenses of the company, the total income that the company actually made for a given accounting year, all right? So that is actually what income statement is all about, okay? Sorry, my internet is actually very slow today. I'm actually trying to give you an example of all these bank statements. So as you can see, this is actually a perfect example of the current of a balance sheet. All right. As you can see, we have the liabilities over here by the right hand side, and we actually have the assets over here by the left hand side. Okay, which is also known as the credit and debit side. All right. So as you can see, we have current liabilities. All right. So when we are talking about current liabilities, all right, we are actually talking about the liabilities of the company that can actually be settled off within a period of a year. Okay, they are also called short-term liabilities. All right, maybe loans. Okay, or a company took. Okay, or just liabilities of a company that the company can actually offset. Okay, within a period of an accounting year, which is 1 year. Okay, so then we talk about long-term liabilities. Okay, so these long-term liabilities are liabilities that the company cannot actually offset within a period of a year. Maybe it could actually take them 2, 3, 4, 5 years or even 10 years, okay, to offset these liabilities. Okay, so these are what we call long-term liabilities. All right. So as you can see, we have the owner equities here. We have owner equity, we have reserves, okay. Then over here we have current assets, okay. Then we have non-current assets. Most people also call this non-current assets fixed assets, all right. So this is actually just an example of a balance sheet, okay. So this is an example of a balance sheet. As you can see, it gives a snapshot, okay, of the liabilities and assets of a company, all right, within a specific accounting year, okay. So let's go ahead and look for an example of income statement. This is an explicit example of an income statement, all right? Like I mentioned, most people actually call the income statements the profit and loss accounts, all right? So this is actually giving us the total expenses, okay, and the total income, okay, of a company for a specific period. And one thing you need to understand is that most company prepares this financial statement, this income statement or statement of profit and loss account every 31st December of each year, okay, every end of the year, all right. So as you can see, this is actually talking about the revenues. As you can see, sales revenues, interest revenues, other revenues, gain or sell of assets. Okay, maybe during the period of a year, the company decided to maybe dispose its assets. Okay, and they gained a profit. Okay, the money they gained from disposing the assets. Okay, is actually what is this. All right. So as you can see, then we have the total revenues on sales. All right, then expenses and losses. Okay, so this is actually where the expenses are actually recorded. Okay, as you can see, the cost of goods sold, depreciation, all right, the rents of the company, salary and wages, commission expenses, office equipment expenses, and every other expenses actually goes over here. All right, so then the total expenses was calculated. Okay, so once the total expenses was calculated, you minus it from the total revenue. All right, and that gives us the net income. Actually, this is not actually very explicit, okay? Because we need to actually get the gross profit, okay, before getting the net profit, okay. So the gross profit of a business is actually the profit of a business before the expenses are being minus, all right, or deducted. While the net income of a business or net profit of a business is actually the profit of a business after the expenses of an accounting period has been deducted, all right. So let's just go ahead and close up this tab. So now let's look for example of income of cash flow statements. So this is an example of a cash flow statement, okay? So this is an example of a cash flow statement, all right? So like I said, the cash flow statement shows the total inflow and outflow of a company, all right? So this is an example of a cash flow statement, all right? This is actually what this is about, okay? So we have talked about the financial ratios. We have actually talked about bank statements, all right? We have actually introduced different kind of bank statements, okay? So now we are going to be talking about the different types of financial ratios that we actually have. Let me just take this off here, please. Okay, so about these notes, you don't have to worry. This board, I will actually be attaching the link to this board to the video, all right? So let's go ahead and talk about financial ratios, okay? We actually have various types of financial ratios, okay? But the specific financial ratios we are going to be looking at today would be talking about the liquidity ratio. We'll also be talking about the stability ratio. We'll also be talking about the solvency ratio. And we talk about the efficiency ratio. We'll also talk about the market value ratio. Okay, so these are the major ratios, all right, we'll actually be talking about for the course of this video. So the first ratio we are going to be looking at today is the liquidity ratio, all right. So when we talk about the liquidity ratio, what do we mean? Okay, so one thing you need to understand is that the liquidity ratio is actually an important ratio, okay, when it comes to financial analysis, all right, because this ratio actually tells the investors and the shareholders, okay, the ability of the company to use its current assets, okay, to settle its current liabilities, all right. So it shows the ability of the company to actually offset its short time, okay, debts, okay, using its short time, okay, assets, all right. So another thing you need to understand about the liquidity ratio is that it is actually divided into two ratios, okay. It is divided into the current ratio and the quick ratio, which is also known as the test asset ratio, all right. So now let's go ahead and take a note into the current ratio and is the quick ratio. Now let's go ahead and talk about the current ratio. Now, when we are talking about the current ratio, okay, it simply measures the ability of the company, okay, to meet its short-term obligations. All right, so it's actually similar with the liquidity ratio, okay. So one thing you need to know is that the formula for calculating this is the current assets, okay, divided by the current liability. All right. When we talk about the acid test ratio, okay, when we talk about the acid test ratio, okay, so the acid test ratio is also called the quick ratio, okay? So this is actually similar to the current ratio, okay? But it just the only difference is that it minuses the inventory, okay, from the current assets, all right, and then divide it by the current liabilities, all right? Formula is giving us. Okay, so this is actually what the quick test ratio, okay, is actually all about. So the next ratio we are going to be looking at is a profitability ratio. All right. So like the name implies, okay, the profitability ratio actually shows the ability of the company to generate profit from its operations. Okay. So one thing you need to understand is that the goal of every company, the end goal of every company is actually to make profits at the end of every accounting year. Okay. So the profitability ratio shows the company whether or not, okay, they have actually made a profit for a given accounting year. All right. So let's go ahead and take a note. So the profitability ratio is divided into two, okay? It's actually divided into the gross profit margin, okay, and the net profit margin. What is gross profit margin? Okay, so one thing you need to understand is earlier in this video I mentioned about the two types of profits, okay, that we have, where I mentioned that we have the gross profit and the net profit. All right, and I mentioned that the gross profit is actually the profit of a business, okay, where that's the profit of a business, okay, before expenses have been deducted, Why the net profit of a business is actually the profit of a business after all expenses has actually been deducted. Okay, so the gross profit margin, what does it show? It actually shows the percentage of the net revenue, okay, that exceeds the cost of goods sold. All right, so to better explain this, we can simply say the gross profit margin, okay, shows the revenue of a company, okay, after its direct expenses has been deducted, which is after its direct expenses, like its cost of goods sold, all right, has been deducted. So let's go ahead and take a note. Okay, so the formula for calculating the gross profit margin, okay, is the revenue minus the cost of goods sold times 100 divided by revenue, all right? So formula. So like I mentioned, all right, after this video, I'm going to be uploading a video, okay, that we will be analyzing a financial statement, okay, together, all right. So we are going to be calculating the financial ratio, okay, for financial statements, all right. It could either be I might decide to use the income statement or the balance sheet, all right, whichever. All right. So this is the formula for calculating the gross profit margin, all right. So the next thing we are going to be looking at is the net profit margin. So when we talk about net profit margin, okay, so this actually simply means the revenue, okay, the leftover revenue, okay, after all the expenses, okay, incurred in the cost of operation of the business has been deducted, okay. So the net profit margin is actually the net profit is actually the actual profit of the business, okay, because this profit is gotten after all the expenses, okay, that the business incurred has been deducted, all right. So let's go ahead and take a note on that. So the formula for this is actually the net income times 100 divided by revenue. Okay. So in the next video, like I mentioned, we are going to actually be applying all these formulas. Okay. So we'll actually be understanding how these formula are actually being used. Okay. When actually working with a bank statement. All right. Let's go ahead and push this and keep this here. So the next ratio we'll be talking about is the solvency ratio. Okay, solvency ratio. Now, this is actually the opposite of the liquidity ratio. Okay, so because this ratio actually measures the company's ability to meet its long-term financial obligations. Okay, that is to meet its debts and future obligations. All right. Now, one thing you need to know is that this ratio is actually subdivided into two. Okay, it is subdivided into the debt to equity ratio and the interest coverage ratio. All right. Now, when we talk about the debt to equity ratio, what are we trying to say? Okay, so this ratio, okay, is the ratio, okay, it actually tells us the amount of debt, okay, that is actually used to finance the company's assets, okay. So it actually shows the amount of debt, okay, that is actually used to finance the company's assets. That means it shows the amount of debt, okay, that is actually used as an asset of the company, okay. So an example of debt to equity ratio can actually be the shareholders equity. Okay. Earlier in this video, I actually talked about the shareholders equity and what it actually means and how it can be calculated. All right. Okay. So there is a formula for actually calculating this debt to equity ratio. Okay. So to the debt to equity ratio, what we have to do is to divide the total debt, okay, by the shareholders equity. All right. Interest coverage ratio. Okay. So this is the second division of the solvency ratio. All right. So this interest coverage ratio, okay, it shows the ability of the company, okay, to cover its interest, okay, with its EBIT. All right. So when we talk about EBIT, we actually mean earning before interest and taxes. All right. So the formula for calculating this is interest is earning before interest on tax, okay, divided by the interest expenses. All right. So let's move this over here. So don't worry, after this video we are going to be arranging those notes and I'll be leaving the link to this whiteboard, okay, in the video description. So the next ratio we'll be talking about is the efficiency ratio. All right. Now, when we talk about efficiency ratio, okay, we can actually get the meaning of efficiency ratio, okay, through the name, okay. So, as the name implies, this efficiency ratio is actually used to measure how effectively a company is utilizing its resources, alright. It shows how effectively a company is managing, okay, and utilizing its resources for its day-to-day operations, alright. So, let's go ahead and take a note. How efficiently a company is managing its resources for its operations. So this ratio is actually divided into two, okay? It is divided into the inventory turnover ratio and the accounts receivable turnover ratio. Now let's talk about each of the subdivision of the efficiency ratio. So now when we talk about the inventory turnover ratio, all right, so this ratio actually indicates how many times the inventory, you know that another name for inventory is actually called stock. Okay, so it actually shows how many times the stock of a company is being sold and replaced over time. All right, for example, if a company actually deals on iPhones, okay, so the inventory turnover ratio shows how many times, okay, a company actually buys iPhones, okay, finish selling the iPhones, okay, and also be ordering the iPhones, okay. So in cost accounting, this is where we have the minimum order ratio, the maximum order ratio, and other metrics too. All right. So let's go ahead and take a note. is. Okay, so this is the formula for calculating the inventory turnover ratio. Okay, so to calculate the inventory turnover ratio, okay, what we have to do is just to divide the cost of goods sold, all right, by the average inventory. And to get your average inventory, what you have to do is to sum your opening cost of goods, your opening inventory, and your closing inventory, and divide it by 2. Okay, so average inventory, opening stock minus closing stock divided by 2. Okay, so that is actually how you can actually get your average inventory. Okay, so the next thing we are going to be looking about is we are going to be looking about at the second division of efficiency ratio, which is the accounts receivable ratio. Now, as the name implies, this ratio actually shows the ability of the company to actually take payments, okay, or to retrieve its debt from its retrieve money from its debtors, okay. So that's actually the simplest explanation to it. It is a ratio that measures how efficiently, okay, a company collects payments from its customers, okay. It could be maybe from its debtors, or how efficiently a company collects money when a customer actually buys their goods. Okay, so let's just go ahead and take a note. All right, so the formula for calculating the accounts receivable ratio is net credit sales divided by average accounts receivable. Okay, so just take this here. All right, so the last thing we are going to be talking about for the course of this particular video is the market value ratio. Now, when we talk about the market value ratio, it actually has to do with the market value, okay, of the company's stock, okay. So this market value ratio is actually used by investors of a company, okay. It actually helps the investors to actually gauge the worth of the company's stock, okay, in relation to its market price. All right, let's go ahead and take a note. So this is actually all we are going to be talking about when it comes to financial ratio. Okay. So before we actually come to the end of this tutorial, I would like us to look at the importance of financial ratios. Okay. So there are various importance of financial ratios. Okay. But we are going to be looking at just few. Number one, we are going to be saying performance evaluation. Now, this can actually fall to the efficiency ratio, okay? because this ratio actually helps the company, okay, to actually understand how they are effectively, okay, making use of their resources, okay, for their day-to-day operation of the business, okay. So these various ratios helps a company to understand, okay, its financial health at every given point in time, okay, like the current ratio, okay, that actually tells the company, okay, the ability, okay, its ability to settle its short-term obligation with its short-term assets, okay. So performance evaluation, we can actually say the financial ratios, they actually provide a benchmark to assess a company's performance over time, okay. Then second importance, we can actually say risk assessment. So these financial ratios, they actually help the company to evaluate risks, okay, that are associated with solvency, liquidity, and profitability, okay, which actually helps the company to actually make informed and strategic decisions. All right. Like we mentioned, okay, when we are defining financial issues, all right, we say that it is actually a very important tool that actually helps organizations to know the financial health or position of each company, okay, at every given accounting period, all right. So when the company is actually able to know its financial health, okay, at any given point in time, okay, it actually helps the company to decide whether to go to invest in a business to get more assets or not, okay. So these ratios actually help the company to actually make informed investment decisions that can actually drive and increase the performance of the company. All right. So the last one we're going to be looking at is financial planning. Okay, so when these ratios are properly calculated, okay, and evaluated, all right, it actually helps the company to actually plan its financial obligations, okay. Like when we are talking about financial analysis, so we are talking about budgeting, okay. Once the company is actually able to calculate these various ratios, okay, it actually helps the company to actually make a proper budgeting, okay, of their financial plan in every accounting period, all right. So thank you for watching to the end of the video. If this is the first time you're seeing my video, don't forget to hit the subscribe button below. I constantly share videos on accounting, data analysis, financial analysis, and data science. All right. So if this is the first time you're seeing my video, don't forget to hit the like button below. All right. Also forget to leave your comments in the comment section. Okay. Don't also forget to like this video. All right. Thank you so much for watching, and do have a wonderful day ahead of you.